Two numbers frame where artificial intelligence is heading next. Global semiconductor sales reached $403.3 billion in the second quarter of 2026. At the same time, Intel is proposing to raise $15 billion in new common stock. One number points to extraordinary demand. The other points to the immense cost of trying to supply it. Taken together, they suggest that AI is no longer just a story about software launches and model benchmarks. It's becoming a contest over physical infrastructure, access to capital, corporate positioning, regulatory power, and macroeconomic resilience. And Asia sits near the center of that contest. Start with the clearest signal in the picture: demand. According to the source material, global chip sales reached $403.3 billion in the second quarter of 2026, up 35.1% from the first quarter. June alone brought in $134.5 billion, up 123.6% from a year earlier. Those are not normal cyclical moves. They point to a sharp expansion in the scale of semiconductor demand, which the source material broadly attributes to AI data center investment. That matters because these figures are large enough to move the entire global semiconductor market, not just a niche part of it. At the same time, the boundaries of the data matter. The source material does not break growth down by product category, company, or region. So the numbers do not tell us exactly which segments are winning or where the gains are concentrated. What they do establish is a demand floor. AI infrastructure spending has become powerful enough to reshape industry-wide sales. That in turn helps explain why companies are preparing for unusually heavy capital needs. Intel's proposed $15 billion stock offering is one example of that financing pressure. According to the source material, the proceeds are intended for general corporate purposes, including capital expenditures and working capital, with the company pointing to growth tied to physical AI and advanced packaging. That combination is revealing. This phase of AI expansion is not limited to writing code or training models. It also depends on costly industrial capacity. Advanced packaging is a good example. In simple terms, it is the process of combining multiple chips into a more capable system. That requires specialized equipment, technical precision, and time. Physical AI carries similar demands because it pushes intelligence into hardware systems, not just cloud-based services. Neither area is a quick-turn business. Both require upfront spending before the returns are clear. Intel turning to public equity markets at this scale shows that capital access is becoming part of competition itself. It is not just a background financial issue. It is increasingly a strategic variable. That is especially relevant for Asia, where semiconductor manufacturing and packaging capabilities are already deeply rooted. As more money is raised to expand capacity, the key question may not simply be who can secure financing. It may be who can translate financing into working production, on schedule and at scale. Capital can fund the build-out. Execution determines who benefits from it. That same pressure to scale is beginning to show up at the boardroom level. According to analysis cited in the source material, global M&A activity reached $3 trillion year-to-date in 2026. Within that, Asia-Pacific is described as moving through a period of strategic consolidation shaped by AI and shifting capital flows. This is an important signal, but it is also a limited one. The source material does not identify the specific deals, sectors, or countries driving the pattern. Even so, the implication is still meaningful. AI appears to be influencing how executives in Asia-Pacific think about capability, scale, and positioning. In other words, the build-out is no longer only an engineering problem or a supply problem. It is becoming a corporate structure problem as well. Companies may increasingly ask whether they need to buy, merge, partner, or divest in order to compete in an AI environment that rewards both technical depth and capital efficiency. The available evidence does not yet let us map the full consolidation trend in detail, but it does suggest that AI is entering strategic decision-making at the deal level, not just the product level. While hardware, financing, and consolidation are pulling one side of the story into focus, the software layer is making policy harder to manage. According to analysis cited in the source material, U.S. efforts to restrict Chinese open-source or open-weight AI models could ultimately backfire. The examples given are Moonshot AI's Kimi K3 and DeepSeek-R1, both presented as increasingly competitive systems. The core issue is that software spreads differently from hardware. A restricted chip or manufacturing tool can, at least in principle, be controlled through borders, licenses, and physical shipment. An open-weight model behaves differently once released. It can be downloaded, copied, modified, and built upon by developers in many places. That makes it much harder to contain through simple prohibition. The point is not that restrictions have no effect. It is that policy designed mainly around bans may struggle when the competitive object is widely distributable software rather than a physical component. If that is right, then long-term advantage may depend less on headline restrictions alone and more on the surrounding ecosystem, compute capacity, infrastructure, talent, and the ability to keep improving systems over time. That distinction matters for Asia because it links the region's hardware role with a growing software and model development dimension. The contrast becomes even sharper when we return to hardware and look at regulation. According to the source material, the FCC under Chairman Brendan Carr has reportedly barred imports of Chinese drones, routers, and data center components on supply chain security grounds. Whether or not those categories seem connected at first glance, the broader significance is clear. US-China technology friction is not limited to familiar tools such as tariffs or export controls. It is also moving through domestic regulatory channels that shape what hardware can enter the market at all. For Asia, that matters immediately. Supplier networks for routers, drones, and data center equipment run through manufacturing ecosystems across the region. Once regulatory screening tightens at that level, then the effects go beyond trade volumes. They can influence supplier qualification, procurement choices, compliance procedures, and the design of supply chains themselves. In that sense, regulation is not just reacting to technology competition. It is helping define the commercial pathways through which that competition operates. All of this is unfolding within a broader macroeconomic backdrop that could either support the build-out or make it more fragile. The source material cites a San Francisco Federal Reserve economic letter, saying the correlation between stock prices and bond prices has flipped. The Fed reads that shift as evidence that markets increasingly see supply-side shocks, especially oil prices and inflation, as the main threat to economic activity. This is not a forecast for the technology sector by itself, and it is not specific to Asia. But it matters because AI infrastructure is being built in a manufacturing-heavy environment. Energy costs, freight expenses, input prices, and financing conditions all affect how quickly capacity can be added and how durable investment plans remain. If supply-side pressures intensify, they could become an important constraint, even when underlying AI demand stays strong. Put these 6 threads together, and a single pattern emerges. Semiconductor sales show demand at a scale large enough to move the global market. Intel's planned capital raise shows how expensive it is to build the physical side of AI. M&A trends suggest that companies in Asia-Pacific are beginning to reorganize around that reality. Open-weight Chinese models show why software is harder to contain than hardware. FCC action shows that hardware controls are spreading into more regulatory channels. And the Federal Reserve's market read reminds us that this entire build-out sits inside a cost-sensitive macro environment. None of these developments proves the others, but together they point to the same transition. AI competition is moving beyond software headlines and into the physical, financial, regulatory, and economic systems that determine who can actually scale. Asia matters because it is deeply embedded in all of those systems at once. Semiconductors, packaging, electronics production, supply chains, and increasingly AI development itself. For investors, the practical implication is to treat AI in Asia as an infrastructure and risk management theme as much as a growth theme. Watch whether semiconductor sales remain strong beyond a single quarter. Watch whether spending on packaging and physical AI becomes more targeted and disciplined. Watch whether Asia-Pacific deal activity produces clearer evidence of AI-driven consolidation. Watch whether Chinese open-weight models gain meaningful adoption outside China. Watch whether US hardware screening spreads into more categories. And watch whether oil prices, inflation, freight costs, or financing conditions begin to weigh on manufacturing economics. The larger shift looks increasingly real. But at this stage, discipline still matters more than certainty.